This is the Amplify Seymour Cannabis ETF first quarter update for 2023. I'm speaking with Tim Seymour. Tim, let's get right to it. What
Thanks,
regulatory updates do investors need to be aware of?
I think the most dominant theme is that there's been no regulatory updates and that the cannabis industry has been waiting for something. And it's like waiting for Godot, for those of you that understand that parable and metaphor. It's as if something that we continue to believe is going to come out of Washington, when in fact, when the government is your partner, often you're disappointed. So I just think the two things that investors should hope for, and the two things that have the highest probability of happening, I think first of all might be rescheduling or descheduling cannabis in terms of it's a Schedule I drug. The implications for that from a tax perspective especially are so punitive for the sector. And that's something that could come from a White House essentially move without a legislative requirement. And that's critical, because right now people are adding up the votes and trying to understand what could get done in the House, what could get done in the Senate. Safe banking and the concept of it, which has many different concepts over the last couple of years, but even most simplified version, I think is something that's not terribly far away from votes, even in a world where we now have different issues confronting the banking sector that we all know have been going on more broadly, whether it's Silicon Valley Bank, et cetera. You have a concern that cannabis banking legislation will never happen. I think that there are folks on both sides of the aisle in the House that are willing to support this bill. We're not putting a timeline on it. I would just say the best news for cannabis investors is that the expectations on the regulatory side are almost nothing at this point, and that's more than priced into the sector.
So before we get into the ETF, we're recording this in the beginning of 2023. We just finished the first quarter. What's your outlook for the rest of the year for the cannabis market?
It's about companies that are generating free cash flow from operations, and those companies that are actually going to be able to survive a difficult environment. And I think survive is not the question for the top 6 or 7 or 10 players. I think they both have the balance sheet, the flexibility, the asset base. But it really is about a sense of these companies, like any industry that's going through a difficult time, whether it is because of the macro, whether it is because access to capital markets has been forced to look at efficiencies, look at price rationalization, look at where they're going to be spending on CapEx and OpEx. The cannabis industry has looked itself squarely in the mirror and understood that the access to capital has gotten significantly worse, even when it wasn't great to begin with. These companies have never been run better. I'll say that. And I think these companies have an understanding of where they need to deliver. At one point, it was for cannabis 2 years ago, even in difficult times. Let's grow as fast as we can, everywhere we can, whether these assets make sense together, whether they fit, whether asset heavy is the right move. The industry is totally different at this point. And I think that's the outlook. Let's find companies that are generating free cash flow and companies that are existing through a difficult time to be ready to fight tomorrow. And I know that's not the most optimistic outlook, but it's actually great relative to where we were. And I think where the market, again, has priced these companies.
Well, that's a great opportunity to pivot to the ETF, CNBS. Let's start for new viewers behind the investment thesis behind CNBS. Could you walk the new person through that?
Sure. CNBS is an active ETF strategy who is focused purely, and the contents being the constituents make it a pure cannabis ETF. More than 50% of the revenues for 80% or more of the companies need to be cannabis specific. So this is a cannabis ETF that really is focused on cannabis, not tobacco companies, not liquor companies, not companies that might someday be here. We're active. We're meeting every day with these companies. I've been in the sector for 6 or 7 years. I've been focused on the sector through the ETF since 2019 when we launched this. And the point has been, we're an ETF that is not waiting for a monthly rebalancing. We're not waiting for a quarterly rebalancing. We're active. We're in the market. We are trying to find the companies that we think are not only the most important, effective, well-positioned companies for today, but we're trying to see where the industry is going from a subsector perspective over the next couple weeks, months, years. It's all part of how we're looking at this.
As you think about the ETF, what is the portfolio construction process from an institutional level?
So we're trying to be global in our geographic construct. We're trying to at least though have exposure to the heaviest weightings to the largest and these highest growth markets. That means that from a U.S. Perspective, we have more than 50%, probably more than 70%, at least when you consider how it rolls back into U.S. Demand is where we're focused. We are trying to be focused in the various subsectors that do exist. So it's not just the big vertically integrated companies, but it's also trying to find companies that have more exposure to the production process, those that have more focus to the retail process, those that have exposure to software, those that have exposure to e-commerce. So this is where we are focused. To the extent that this is a 40 Act SEC governed product, this is a product that we have to make sure that all of the companies that we're investing in fit those criteria. And that means liquidity construct. That means from an accounting perspective, that means the exchanges that they trade on. And to that extent, it's really critical that we're investing in companies that we think are not only here today, but here tomorrow.
When you look back on the first quarter, what changes did you make in the portfolio?
Largely what we've been doing is trying to either stay cash heavy at a difficult time for the industry. We've also, I would say, been continuing to cut some exposure in Canada. What we found is that this industry continues to restructure. We've tried to find other ways to have exposure to some of the call them the financial backed products, REITs, BDICs, companies that at least are going to possibly outperform, we hope outperform, and there's no guarantee of that in a difficult environment. Those companies that are based upon, again, a yield or a senior secured collateral perspective. That's been really what the industry is about. It's about risk management right now. And we've kept a high degree of cash in the portfolio while exiting some companies that we think have proven that they're, if anything, continuing to burn cash. So we're really trying to position the portfolio to be ready for that next move forward. But again, I get back to, it's not as if we're investing for a particular headline we're looking to see. We're putting our heads down. We're finding the companies that are investing in their own businesses, but are, we think, the most efficient players in the industry. Remember, for cannabis right now, it's not a question of demand. The demand construct for cannabis is that this continues to be a top line growth story. It's the other issues for cannabis. It's supply, it's regulatory, it's some of the inefficiencies of the market, the lack of capital. These are the things that have been the challenges for the industry. But it's not about this big picture. Hey, why are we all investing in cannabis? That demand construct is there.
So before we wrap up, could you talk about some of the holdings in the portfolio that you're paying particular attention to at this stage?
Sure. I'd say in the U.S., the player that we think has been proven to be the most cash flow generative and the one that we think is possibly positioned in the best markets, and that means states, and that means certain parts of the vertically integrated chain. GTI, it's at this point our largest U.S. position, Green Thumb Industries. And we look north of the border. I mentioned Canada, but Tilray is a company that over the last 4 years has changed dramatically. It's a company that when it merged with Apria, they were the two largest players, or two of the three largest players in Canada. But the key to Tilray, and since we have invested in it, we didn't invest in it in Tilray 1.0, but I would say we've been in 2.0. And the company, while it's in a Canadian market that is $5 billion and capped and not anywhere, not even as big as the largest U.S. state in California. But Tilray's been investing not only in their distribution in Europe and their exposure to being in that market for when it actually really does, we think, take the next step. And that may be another one of those catalysts for 23, late 23 and 24. I think the key here for Tilray also is that it's a company that's diversified into other parts of the spirits world and other segments that we think are very complementary to cannabis. It makes the company cash flow generative. It makes the company able to, I think, better position, better hedge itself during a difficult time. The CEO is a veteran of the CPG and kind of consumer product world. And we think that Tilray is really well positioned to be a broad-based, diversified player, both in cannabis and to some extent have some exposure outside of it that right now is really strong.
Tim, thank you for your time. As always, viewers, to learn more about CNBS, visit cnbsetf.com.